Hey, what's up, my friend? So here's the thing, right? I know that there are so many trading strategies out there, systems, right? And it can be overwhelming for you as a trader. Which strategies do you trade? Which one do you focus on? Which strategies is best for you? What are the pros and cons of all these different strategies? There are a lot of questions in your head, and I understand it. So that's why in today's video, I want to share with you, right, the 4 main types of Forex trading strategies out there. Alright, if you look at all the systems, all the strategies, it can be categorized into one of these 4 categories. I'll walk you through what is it, how it works, the pros and cons, and how to decide, which strategy is best suited for you. So all this and more in today's video. Ready? Let's get started. Number 1, day trading. So as a day trader, right, your goal here is just to capture the intraday volatility. What do I mean by it? So different markets, right, each day they move in different amount. For example, right now euro dollar tends to move about 55 pips a day. For blue chip stocks, it tends to move about 1-2% a day. So you can see that different markets, right, different instruments, they have their own intraday volatility. So as a day trader of those markets, your job is just to trade, to capture that volatility of the day. So if euro dollar moves about 55 pips a day, as a day trader, maybe you're just trying to capture that 20-25 pips, right, out of that entire 55 pips on average that it does for euro dollar on a single day. So that's what I mean by capturing the intraday volatility. And the way you do it is that you usually get your bias on the higher time frame. I'll explain this one later bit. And as a day trader, you typically trade off the 30 minutes time frame and below. And because of the fact that you're trading on the lower time frame, right, markets tend to move faster because every candle is painted, once every, let's say, once every 30 minutes for 30 minutes time frame, once every 5 minutes for 5 minutes time frame. And it's not possible, right, to be trading like 40-50 markets. So that's why as a day trader, you typically focus anywhere between 3 to 6 or 7 markets. That's about it. That's pretty much the most that you can handle at any one time. So let me explain to you how this day trading, capturing the intraday volatility by getting your bias on the higher time frame. Let me show you how it works, right? So let's say, for example, New Zealand Swiss franc, right? Let's say this is the daily time frame, okay? And you notice that this market, let's say, assume, right, this is the current price action on the daily time frame. You notice that, okay, the higher time frame, the daily, it's in a downtrend. Market is at this area of resistance, so let's call it R, and you have multiple price rejection, right, at this area of resistance. So you have a downtrend and price is at resistance. Okay, let's give this 2 ticks. So this gives you a bias, right, as a day trader, is that you don't want to be long at this point in time, right? Because higher time frame, the price is at resistance. Higher time frame, the market is in a downtrend. You don't want to be long. You don't want to be buying at this point in time. And on top of it, right, the market has given you clues, right, that it's rejecting higher prices. Look at the wick here, the upper wick over here, and this upper wick over here. So as a day trader, right, using this information that you have, right, you want to short the markets on an intraday basis. So what you'll do is that you can go down to a lower time frame to look for an entry. So on the 15 minutes time frame, right, let's say, so let me just, so what you saw earlier on the higher time frame, right, the multiple price rejection is pretty much this whole section over here. Okay, so as a day trader, let's say you notice that this market right now is forming a build up at this area of support. Okay, just giving you an example, right? Market is now forming a build up at this area of support. So you might be thinking, okay, higher time frame is in a downtrend, price is at resistance. This area of support is likely to break down. So let me look for shorting opportunities, right? Maybe you could look to short the breakdown of this swing low. That might be one. Or maybe you could look for a retest of, a previous support turn resistance, like maybe this one over here, price breakdown. Then you have a retest of previous support turn resistance. This could be another opportunity to short. So hopefully this gives you an idea to how intraday trader work, right? They get their bias on the higher time frame and then they time their entries on the lower time frame. And they usually get out their trade, right, before the session ends, before the day ends. Okay, so this is what intraday trading is about, right? What day trading is about, at least for the Forex markets at least. So the pros and cons, right? So for day trading, if you are good, you can make money on most months. Why is that? It's because as a day trader, you have ample trading opportunities and you can be trading anywhere between 50 to 100 times a month. And if you have an edge in the markets, right, 50 to 100 trades, right, is enough for your edge to play out over time. So this is why you can make money on most months. And you have no overnight risk because you exit all your positions right before the day ends. The downside to it, right, is that day trading can be stressful. It is stressful because you're watching the markets all the time, right? You're glued to the screen and you're always having to be aware, right? If you any potential news coming out, anything that could affect your trades, when it's a next trading setup coming in, yada yada. Okay. And another thing to consider is that there is high opportunity cost in day trading, right? This is something that a lot of traders neglect. For example, let's say you have a 100k trading account, you make 5% a month on average. In a year, that's about what? 60 grand, 60k. Okay. At the same time, right? You could have been working elsewhere full time, right? Making about 5,000-6,000 a month. That's also about almost $50,000-$60,000 a year, similar to your day trading endeavor. And chances are you're working less hours, and chances are it's less stressful. Okay, so this is the opportunity cost that you have as a day trader, because if you are day trading, you would forego, right, an opportunity cost of working elsewhere or making an income via some other methods, right? So don't forget to take into consideration the opportunity cost as well. Moving on, swing trading. And by the way, if you're enjoying this video so far, hit the thumbs up button, right? So this way, I know that you're enjoying it. And if you don't like this video, you hate it, subscribe to my YouTube channel so I have chance to convince you in future, right, that hey, my videos are worth watching. So do it right now. Hit the thumbs up button and subscribe to my YouTube channel. The button is all below. So moving on, swing trading. So as a swing trader, what you're trying to do is to capture one swing in the market, just one move, one wave, just one swing, right? So let me just illustrate to you what is one swing. So there are a couple of ways this can work, right? So for example, the market is in a range. So one swing could be, let's say, buying near the lows, right? And the market move up one swing higher and exiting near the highs. So this over here, from here to here, is one swing in the markets. Alternatively, right, the market could be in a trend, right, like this, higher highs and higher lows. So one swing in the market could be buying near the lows and exiting near the highs over here, and this again is one swing. Now some of you might be thinking, hey Rainer, how do I know where this trending move might end, right? How do I know that? Well, I'll share with you a technique later to how you can actually predict, right, this highs in a trending market, but later on. And as a swing trader, you typically trade off the 1 hour time frame and above, right? Maybe the 2 hour or even a 4 hour time frame. And because you're trading off this higher time frame, you can trade more markets because the charts, right, it's only painted once every 4 hours, for example, on a 4 hour time frame. So you can trade anywhere between 20, 30, 40 markets. It's possible. So now let me share with you, right, how swing trading looks like on a chart and how you can actually so-called predict the end of the trending move in the trending market. So let's have a look at the this bond market, the 10-year. So you can see that over here, right, if you just pull out the 50 MA, you know that this market is in a healthy trend. Market tends to pull back towards the 50 MA, tends to pull back to previous resistance, now turn support, and then reverse from there. So as a swing trader, your goal is just to capture that one swing in this trending market. This is one swing, this is one swing, this is one swing, this is one swing. Your goal is just to capture that one swing. Right, and the beauty of swing trading is that you don't have to endure the retracement that comes along with it, right? This retracement that comes along with it, and this retracement that comes along with it. So now, how do you know, right, ahead of time when this trending move is about to reverse, right? Like for example, how do you know it's about to reverse at this highs? How do you know it's going to reverse at this highs? Okay, so let me share with you a technique. You want to use a tool called Fibonacci extension, right? Just go to here, right? Fibonacci. In this case, it's called the trend-based Fib extension. It's a Fibonacci tool. And what you want to do is to, in an uptrend, right, plot it from the swing low to the swing high. Okay, this is the swing high. Plot it to the swing high and pull it back down to the swing low. Okay, so let me just illustrate how you draw it. From the swing low to the swing high and down to this swing low over here again. The reason why I give it some space apart because you want this levels to be shown. So once you've done it, right, you want to look, right, and you notice that there are 3 levels, right? The 127, the 162, and the 2.0. Okay, let me explain to you how these numbers come about. So what it does, right, this tool is that it calculates the distance from this swing low to swing high, right? This distance. Okay, let's say this distance, it's I think layman term, it's what is cm, right? Let's say it's 10 cm. 10 cm. I mean, you can call this in dollars, in units, whatever, but let's put it 10 cm so you know what it means. So how you get the 127 extension is you just take 10 cm multiplied by 1.272. Just take 10 multiplied by 1.272. And you get this figure over here, right? This figure over here. If you just take, let's say the distance here is 10 cm, you multiply by, let's say, 1618. Right, 1618. That's how you get this figure here. And 10 cm multiplied by 2. right? That's why this 2, you get this figure over here. So I'm using 10 cm as an illustration, right? You can call it X, you can call it Y, whatever. So that's how you get your figures over here, and it gives you this this different price projection. So now here's the thing, right? As mentioned, right, which level do you pay attention to? So to be conservative, right, to have a higher chance of, getting out with a profit, you want to look to target the 127 extension. That's the most conservative measure, right? The 127 extension. And if you want to give your trade a little bit more lee room to run, right, the 1618 is another possibility, or the 162, whatever you call it. Okay, so this is a couple of techniques that you can use, right, to give you an idea to where the trending move might potentially end. So again, right, let's say now let's say somehow you bought at this lows over here near the bounds of the 50 MA. What you'll do is just take this tool, swing low again to swing high, pull it back to the swing low, and in this case, right, the price actually did even retest back to the 2.0 level. But again, there's no way to tell, whether it's gonna reverse from the 127, the 162, or the 2.0. But generally, the more conservative approach is between 127 and 162, right? So this is a technique that you can use, right, to give you an idea to where you can exit the trade for so-called maximum profit potential. So moving on, right, another example, it's this one is more of a swing trading in a range market. So if you look at this chart, right, at this point in time, okay, notice that this market is somewhat in a range, right, between these highs and this lows over here. Then market came down into this area of support. Let's say you had a buying opportunity to go long. So as a swing trader, where do you exit the trade? Well, this is a little bit different because now it's no longer a trending market. It's more of a range market. And in a range market, as a swing trader, you want to exit your trade, right, before opposing pressure comes in. So now ask yourself, where will opposing pressure comes in? Where would the sellers come in? And if you look at this chart, if you ask me, right, sellers could possibly come in within this area over here, right, where previous support could become resistance, right? So this is a possible area to look to capture one swing in the market, right? So in this case, this will be your one swing, right? Buying from this lows and exiting near this high. So there you have this one swing, okay? So that is what swing trading is all about. Pros and cons, right? If you are good, you can make money on most quarters. Why most quarters is because compared to day trading, swing trading, you don't get as many trading opportunities. So you need time for your trades to play out, right? So again, if you're good, if you have an edge in the market, you can make money on most quarters. It's possible to trade part-time because you don't have to be glued to the screen all the time. For example, if you trade off the 4-hour time frame, you can just check the charts, right, once every 4 hour, right? So you can trade it part-time. The cons is that you won't be able to ride trends because remember, as a swing trader, you're just going to capture that one swing. You're going to exit the trade before the opposing pressure comes in, before the retracement comes in. So this is why you'll never ride trends. You have to embrace it. And you also have overnight risk, right? So you might be affected due to, news impact and stuff like that. So swing trading, this is something to be aware of. Moving on, right? Position trading, right? So what is position trading? So position trading, you can think of it as like, trend following, basically riding trends in the market. So just an example, right? Let's say riding trend is like market in a range, okay? Then it breaks out, trend, then it reverse, right? So you exit somewhere here after the market show signs of reversal when it has hit your trailing stop loss. So this is what position trading is all about. And as a position trader, the key is to trade many markets. You have to trade many markets because there are times, right, where markets is not going to trend, and if you just trade a few markets, you're going to get stuck in those few markets and suffer a lot of whipsaw. So the more markets you trade, right, the odds, right, you will capture a trend. So you want to trade many markets, and your time frame is daily and above. You can do it on a daily time frame or even a weekly time frame. Okay, so this is position trading. And the pros and cons, right? So before we talk about the pros and cons, right, let me just share with you an example, right? So one example is the dollar against the Chinese yuan, right? This is a trending market actually, and it's statistically this is a trending market. I've done a backtesting on it, and you can see that this market, right, actually is in a potential accumulation stage over here, right? This range, then it pretty much broke out of this resistance, and it started trending. Okay, so you can see that as a swing trader, it's unlikely you'll be exiting your trade anywhere even near this highs. I would say anywhere here or maybe somewhere here, right? That's as much as swing trader would go. But as a position trader, this is where you can capture a trend, right? And one way to go about it is that you can use a tool like, let's say, the 20 period moving average, right? Exit the trade only if the price breaks or close below the 20 MA, which is somewhere here. So this is where a position trader can ride this so-called entire trend, right? The entire so-called move right? Not just one move, but multiple moves, right, in the market. So this is what position trading is all about. Okay, so that is it, right? And talking about the pros and cons, right, is that it can be done in less than an hour a day, right? Reason being is you're trading off the higher time frame, like the daily or even the weekly. You don't need much time. Probably doesn't even interfere with your full-time job, and there's really not much stress, right? It's either there's a trade, there's no trade, or you're just riding the trend. That's pretty much it. The downside is that there's a low number of trades because you don't get trading setups often. Okay, and you also have to be comfortable watching your winners become losers because the market could break out, you're in the money, and then it does a sudden reversal back, right? And becomes a false breakout and it hits your trailing stop loss and you get stopped out for a loss. So it's very common to watch your winners become losers and you gotta get comfortable with it, okay? This is the truth. So that is position trading. And one more technique is, one more style is transition trading. So this is it's something that I hesitated to put this in because this is more of advanced trading, but still I put it in anyway. Okay, for traders who have been trading for a while now, this is a trading style that you can consider, what I call transition trading. So the way transition trading works is that, again, you get your bias on the higher time frame, you time your entries on the lower time frame, just like a day trader. Okay, but if the trade, right, or the market condition makes sense and the trade goes in your favor, you can actually manage your trades on the higher time frame. I'll give you an example later. Again, transition trading, you will typically focus only on a few markets and you adopt a multiple time frame perspective. An example. So if you look at this one over here, let's say New Zealand dollar, okay? And again, at this point in time, right, you look at this again, it's kind of similar to the New Zealand Swiss franc one you saw earlier. Price is in a downtrend overall, higher time frame, at resistance and multiple price rejection over here. And let's say you got an entry on the lower time frame, like let's say the 15-minute time frame. Okay, 15-minute time frame. Let's say I don't know, for whatever reason, maybe let's say you had a shorting opportunity, right? Let's say you had a shorting opportunity at this previous support, right? Now become resistance, so you went short on this price rejection. Okay, so let's look in deeper. Okay. And also bear in mind that since you're entering your trades on the lower time frame, right, your stops is also based on the lower time frame. So let's say you went short over here again, right? Then stop loss, let's say 1 ATR from this high. So let's say somewhere about here. All in all, your stop loss is like what? I don't know, 10, 12 pips, right? At the same time, you know that on the higher time frame, market is in a downtrend at resistance and showing multiple price rejection. This could be a move that could play out really well. And let's say you went short over here, and again, right, of course I cherry picked this chart, right, to show my point of how transition trading work. And in this case, the market pretty much went in your favor. I mean, quite a bit, right, all the way down, right. At the same time, right, you have to be able to swallow this so-called move against you. Most probably, a lot of traders will not be able to swallow this retracement. So that's why one tip to share with you is that as a transition trader, let's say you short one lot, okay? You don't want to hold that one lot, right? And watch your equity curve go up and down for that full one lot because it's a roller coaster ride, right? You can imagine that at this point, right? Maybe you're up like 2 or 3 hours on the trade, and market reverse you right back to break even, close to break even. So this is why one technique that a transition trader do is that when the market moves 1 hour in their favor, right, 1-to-1 risk reward ratio, they would exit like maybe a third or half their position. So the remaining half, right, is so-called like technically in a risk-free trade, right, quote unquote risk-free, and they will let the remaining half ride for as long as possible. They will let the remaining half, right, manage it using the higher time frame analysis, using the higher time frame market structure. So for example, let's say you went short at this point, okay, and you took a 1-to-1, let's say somewhere near this swing low. You have the remaining half riding, and your remaining half, right, could be trailing it or managing it on the higher time frame, right? Like for example, you know that on the higher time frame, price is approaching this swing low over here. Maybe you can take the last remaining half at this swing low over here. Can you see how transition trading works, right? You time your entries on the lower time frame, and if conditions permit, right, market moves in your favor, you can use the higher time frame, right, to take profit, right? And this gives you a very favorable risk to reward on your trade, and that's what transition trading is all about, right? Basically, timing your entries on the lower time frame and managing your trades on the higher time frame. So pros and cons, right? You can achieve insane risk to reward on your trade, possibly 1 to 10 or more. And reason being is that your stop loss, right, is tight because you're timing your entry on the lower time frame. The downside is that most trades will amount to nothing, right? You hit your 1-to-1 on that position for half of it, and the remaining half just get stopped out at break even or for a loss. So most trades are just like, scratch trades, right? Like small wins, small losses, amount to nothing. But the few, right, are those that really will make a huge difference to your bottom line. And another thing is that it's mainly for experienced traders, because you can see that you are utilizing multiple time frames analysis. You're utilizing multiple time frames trading techniques together. For example, this one is combining both day trading and swing trading together to give you this transition trading. Okay. So which trading strategy should you go with, right? The question is, right? So first question to ask yourself is that, do you want to grow your wealth or make an income from trading? So there's a difference. When I talk about growing your wealth from the markets, right, it means like making 10%, 15% a year, right? That's growing your wealth, making X% a year. But when you talk about making an income from trading, right, it means could be, you're looking to make like 3 to 4% a month, or maybe 5 to 6% every quarter. So you're looking for some consistency. So if you want to grow your wealth, right, in the markets, right, you can adopt either a swing or position trading approach. But if you want to make an income, right, that's where you need to look at day trading or transition trading. Okay. Number 2, how much time can you devote to trading, right? If you just graduate, you want to do this full time, then clearly, right, day trading is for you. But if you are having a full time job, you don't want to do this full time, then hey, you got to look at swing trading or position trading. If you want the least amount of time, position trading. If you want more action in the markets, but at the same time, right, don't want to be glued to the screen, then swing trading. And if you want to do it full time, day trading. And thirdly, right, does the strategy suit you? So for example, position trading, right, I mean, it's awesome, right, to ride big trends, but maybe you're not suited to ride the trends because you're not comfortable in watching your winners become losers, right? You feel a lot of pain, right, when those winners become losers, right, when those green become red. And if you feel a lot of pain, then you might consider, swing trading, where you just look to capture one swing in the markets. So again, right, ask yourself, right, does the strategy suit you? Do you exert a lot of mental capital? Do you feel a lot of pain psychologically when you execute a strategy? If it doesn't really hurt you, if there's really not much pain, then that strategy probably is for you. But if you feel a lot of pain, that strategy clearly isn't for you, right? Simple. So as a quick recap, today we have talked about day trading, right? Basically capturing the intraday volatility. We talk about swing trading, capturing a swing in the markets. We talk about position trading, riding trends in the market, and transition trading, which is a combination of multiple trading styles together. And for those of you who want to learn more about this type of trading techniques, right, on how you can actually read the price action of the markets, how to better time your entries and exits, right, what I want you to do is go down to my website, okay, where I have a book for you, right, a ebook, right, tradingwithrainer.com. Scroll down, alright, so depending what you want, if you want to learn how to better time your entries and exits, reading price action, download this book over here, right, The Ultimate Guide to Price Action Trading. If you want to learn how to ride trends in the market like position trading, then trend following is for you. Click this orange button and I'll send it to your email for free, right? So just go down to my website, tradingwithrainer.com, download these guides, it's free, and enjoy it. So with that said, I wish you good luck and good trading. If you're enjoying this video, hit the thumbs up button and subscribe to my YouTube channel. Button is below, and I will talk to you soon.